Financial literacy is a crucial aspect of our lives, but it's often shrouded in myths and misconceptions. These myths can lead to poor financial decisions and can have a significant impact on our financial well-being. Here in this video, we will debunk some of the most common financial myths. The video is going to be very informative and interesting. So, subscribe to our channel now and hit the bell icon for regular updates. Let's get started. Myth number 16. Keep your savings and checking accounts in the same place. The myth that you should keep your savings and checking accounts in the same place is a common one. However, it is not always the best practice. According to a CNBC article, it is not ideal to keep all of your money in one main bank, especially since brick-and-mortar banks typically have very low interest rates when it comes to savings. In fact, keeping your savings and checking accounts at separate banks allows you to seek the best deals for each type of account. Just because a particular bank offers a high interest rate on its savings accounts doesn't mean it offers good deals on its checking accounts. There's no rule stating you have to keep both types of accounts open with the same institution. However, there's a big benefit to having a checking account and savings account at the same bank. It makes it easier to transfer money between accounts, and you can often avoid fees for transferring money between accounts. So while it's not necessary to keep your savings and checking accounts in the same place, it can be convenient. Ultimately, it's up to you to decide what works best for your financial situation. Myth number 15. Gold is the best protection against inflation. Gold has been a popular way to store wealth for thousands of years, and it's often considered a safe haven asset in times of economic uncertainty. However, it's important to remember that gold does not offer a guaranteed protection against inflation. While gold prices have historically risen during periods of high inflation, there have also been times when gold prices have fallen despite high inflation rates. In fact, a gold investment in previous high interest rate times, around 1980, would have lost money in real terms until today one. Gold is also not a yielding asset, meaning it does not pay dividends. So while gold can be part of a diversified portfolio, equities offer a better hedge against inflation. For example, from 1988 to 1991, the US dollar lost 17% in value due to inflation, while gold lost 24% in value. In short, while gold can be a valuable addition to a diversified portfolio, it's important to remember that it does not offer a guaranteed protection against inflation. Myth number 14. Good budgets are always super restrictive. Budgeting is a powerful tool that can help you achieve financial freedom. It allows you to take control of your finances and allocate your funds according to your priorities. By creating a budget, you can identify areas where you are overspending and make adjustments to ensure that you are living within your means. A common misconception about budgeting is that it is a restrictive practice that limits your spending. However, this couldn't be further from the truth. A budget that feels like a punishment will be impossible to maintain in the long run. Instead, it's important to build in cushions and rewards to make your budget sustainable. This could mean setting aside a small amount of money each month for a fun activity or treating yourself to a nice meal after achieving a financial goal. Myth number 13. When it comes to investing, intuition is better than strategy. It's natural to feel anxious when the markets drop and excited when they rise. However, it's important to remember that investing based on emotions can lead to poor financial decisions. Instead of relying on your intuition, having a clear investment strategy that is built around your personal goals and reflects your risk tolerance is the best way to manage your money. Consulting a wealth planner can be a great way to get started. A wealth planner can help you identify your financial goals, assess your risk tolerance, and build a plan that is tailored to your needs. They can also provide you with valuable insights and advice on how to manage your investments and navigate market volatility. You can say that while it may be tempting to rely on your intuition when investing, having a clear investment strategy that is built around your personal goals and reflects your risk tolerance is the key to success. Myth number 12. Bonds are more secure than equities. Bonds have done very well for 40 years between 1980 and 2020 due to falling interest rates, from peak inflation in the early 80s to the negative interest rate environment the market saw a few years ago. However, if you were only invested in bonds during the last 3 years, you would not have done very well. Most bonds also don't provide protection against inflation and have recently shed value. An example is the Austrian 100-year bond, which has lost 2/3 of its value since issuance. But don't count fixed income out just yet. Bonds are currently quite attractively priced and provide a handy tool for diversification, long-term wealth preservation, and accumulation. The relevant question to answer is which mix of bonds and equities will help me achieve my long-term investment goals. Myth number 11. Only speculative investors buy stocks. As a matter of fact, most types of investors should invest in stocks. How many percent of your portfolio should be comprised of stocks is determined by your risk ability, risk tolerance, and investment time horizon. Speculators are usually looking for high-growth titles, using concentrated bets and frequent movements in and out of the market. This is neither sustainable for the average investor nor a recommended recipe for wealth preservation and conservative growth goals. Investors should invest in stocks in a diversified way, stay invested for prolonged periods of time to truly benefit from compound interest. Myth number 10. Investing in the stock exchange and going to Las Vegas are more of the same. It's true that single-deck blackjack has the best odds of winning at a casino in Las Vegas, with a maximum winning probability of 49.7%. However, it's important to remember that gambling is based on luck, and there is no guaranteed way to win. When it comes to investing, following a disciplined approach based on diversification and asset allocation is the key to success. A balanced investment portfolio consisting of 50% equities and 50% fixed income can provide investors with a good balance of risk and return. According to historical data, a balanced portfolio with this allocation would have had a positive year from 1994 until 2022, 79.3% of the time. To sum up, gambling may be tempting. It's important to remember that it's based on luck, and there is no guaranteed way to win. When it comes to investing, following a disciplined approach based on diversification and asset allocation is the key to success. Myth number 9. Owning a home is always better than renting. Owning a home is often considered a symbol of financial stability and success. However, it's important to remember that homeownership is not for everyone. The costs of homeownership can be significant and can outweigh the benefits. For instance, property taxes, maintenance costs, and mortgage payments can add up quickly and put a strain on your finances. Renting, on the other hand, provides flexibility and eliminates unexpected expenses. You don't have to worry about maintenance costs or property taxes, and you can move to a new location with ease. Renting also allows you to save money that you can use for other investments or expenses. Myth number 8. Only anxious investors diversify. Diversification is the process of spreading investments across different asset classes, industries, and geographic regions to reduce the overall risk of an investment portfolio. Nearly 80% of your investment returns can be attributed to your asset allocation, which makes this practice paramount for all, not only anxious, investors. It is often described as the only free lunch in investing, as it reduces the amplitudes of the ups and downs with the same expected return at the end. Diversification is one of the most effective strategies for reducing overall investment risk, while also providing long-term performance at the same time. Myth number 7. Investing in your home market is a safe strategy. It's important to remember that investing in a single country or region can be risky. Just like single stocks or selected asset classes, countries also face risks. While investing in a particular country may seem like a good idea at the time, unforeseen events can quickly change the investment landscape. For example, investing in China was a popular choice until March 2021 as a result of its economic boom. However, in 2023, several market experts changed their opinion and became more cautious. China is not the only example. Just think of the UK after Brexit or the Greek government debt crisis starting in late 2009. Investing in your home market is no guaranteed strategy for success. By diversifying your investments across different countries and regions, you can reduce your overall risk and increase your chances of success. Myth number 6. Cash is the best store of value in a financial crisis. It's true that financial crises are rare and difficult to predict. Holding on to cash during these times may seem like a safe option, but it's important to remember that cash is not a long-term investment strategy. In fact, holding on to cash is a guaranteed way to lose money, as your assets do not grow if they are not invested. When you hold money in cash, you not only miss out on dividends and compound investing, but you also lose your purchasing power due to inflation. As the cost of goods and services increases over time, the same amount of cash buys less, effectively diminishing the value of your savings. It may be tempting to hold on to cash during uncertain times. It's important to remember that cash is not a long-term investment strategy. By investing in a well-diversified portfolio of assets, you can achieve your financial goals and build wealth over time. Myth number 5. All debt is bad and credit card debt is worst. Debt is a common financial tool that can help you achieve your goals, but Not all debt is created equal. Mortgages and student loans, for example, can be considered good debt because they can help you achieve financial goals or increase your earning potential. Mortgages allow you to purchase a home, which can be a valuable asset, while student loans can help you invest in your education and future career prospects. Credit cards can also be a useful financial tool if used wisely. Paying your balance in full each month can actually boost your credit score and earn you valuable rewards. However, it's important to avoid carrying a balance and accumulating interest, as this can quickly lead to credit card debt becoming a problem. Myth number 4. Now is the wrong moment to invest. It's true that for investors with the goal of long-term wealth preservation and growth, any time is a good time to invest. While it's natural to feel anxious about market volatility, staying invested and having patience are key to achieving your financial goals. There will always be a reason to buy and sell, but having an investment plan and following it diligently will result in higher returns than staying on the sidelines. By investing in a well-diversified portfolio of assets and staying invested for the long term, you can achieve your financial goals and build wealth over time. In short, while it may be tempting to try to time the markets, the evidence suggests that staying invested and having patience are the keys to success. Myth number 3. Warehouse club memberships always pay off. Memberships can be a great way to save money if you use them wisely. However, it's important to evaluate your spending habits to see if the savings outweigh the annual fee. For example, if you only shop at a wholesale club once or twice a year, it may not be worth paying the membership fee. When shopping at wholesale clubs, it's important to focus on buying in bulk for non-perishable items or things you use frequently. This can help you save money in the long run and reduce your overall grocery bill. However, it's important to avoid buying items that you don't need or won't use, as this can lead to waste and negate any potential savings. Memberships can be a great way to save money if you use them wisely. By evaluating your spending habits and focusing on buying in bulk for non-perishable items or things you use frequently, you can make the most of your membership and save money in the long run. Myth number 2. Money can't buy happiness. It's a common belief that money can't buy happiness, and while that may be true to some extent, it's important to remember that money can provide security and opportunities that contribute to overall well-being. For instance, having enough money to pay for basic necessities like food, shelter, and healthcare can reduce stress and anxiety, which can have a significant impact on our mental health. Money can also provide us with opportunities to pursue our passions and interests, which can bring us joy and fulfillment. For example, having the financial resources to travel, take classes, or start a business can open up new doors and help us grow as individuals. In short, while money may not be able to buy happiness directly, it can provide real insurance against misery. Myth number 1. Timing the market is key to being successful. The adage, "time in the markets beats market timing," is a well-known investment principle that has been proven time and time again. Trying to predict the perfect time to buy or sell stocks is statistically improbable and not a sensible strategy for investors. Instead, investing for the long term and staying invested in the markets is the key to success. By staying invested in the markets, investors can benefit from compounding interest, which can significantly increase their returns over time. Compounding interest is the process of earning interest on interest, which can lead to exponential growth in your investments. Additionally, staying invested in the markets can help protect investors against inflation, which can erode the value of their savings over time. Conclusion. In conclusion, financial literacy is a crucial aspect of our lives, and it is essential to debunk the myths that surround it. It is important to understand the basics of finance to make informed decisions. Learning these concepts can save you time and resources in the long term. Networking events, peer discussions, and podcasts are all great ways to learn about finance without investing too much time. Engaging your team in financial planning can lead to more comprehensive and effective strategies. Financial literacy can improve your confidence in business decision-making. So, debunking financial myths is a crucial step in embracing financial literacy. It is important to understand the basics of finance to make informed decisions. Financial literacy can improve your confidence in business decision-making. That's all for today's video. We hope you enjoyed it. Which of these myths did you find the most interesting one? Let us know in the comments below. Remember to hit the like button, share this video, and subscribe to our channel for more exciting content. Thank you for watching, and we'll see you at the next one.